Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. One of the byproducts of rising interest rates is investors who are looking for dividends and payouts now have alternatives. So companies that pay dividends often see their stocks drop and their dividend yields rise as a result. In a market like this, that leaves a lot of attractive dividend yields for investors who are just looking to buy great companies and hold them long term. And there are 5 that I think are a really great buy today. That's what I'm going to dig into. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you like this video, check out my newsletter, Asymmetric Investing, in the show notes. I want to start with a pair of companies that have a lot of similarities. That's Verizon and AT&T. Now, these two dividends are 7.8 and 7.7% respectively as I'm recording, but their businesses are actually improving. In the second quarter, both of them saw lower capital spending, higher cash from operations. That means there's more money left over to pay dividends, to pay down debt. The financial integrity of both companies is improving pretty quickly. And we can see that in some of these charts. This is the cash from operations for both Verizon and AT&T. And you can see that the numbers are lumpy, but they're actually really steady. Right now, cash from operations hovering in that $35 to $40 billion per year range. And like I said, both companies actually recently saw an increase in cash from operations in the second quarter. That's partially because of price increases from cost cuts, but the general trend here is that cash from operations is actually getting better. But you can see over time that the dividend has actually risen pretty sharply for both companies. That is as the stocks have dropped. That has been a really pronounced drop over the last year as the market has recovered a bit. One of the concerns that investors might have is that both of these companies are putting a ton of money into capital expenditures, building out their telecommunications networks. That takes a lot of debt and a lot of financial muscle. But debt to EBITDA multiples of about 3.5 is actually fairly reasonable for companies like this. And I know Verizon said on its conference call recently that they're targeting a debt to EBITDA of 2.5 in the near future. So the general story here is that the telecommunications, specifically wireless telecommunications, is one of those very sticky products. There's ebbs and flows and who's growing, who's not, who's gaining customers, who's losing customers. But at the end of the day, there's only 3 major suppliers in the market, and they control a vast majority of the spectrum here in the US. That means that there's ultimately pricing power. Now, what's made the last couple of years a little bit difficult for investors is we've been in this massive investment phase, building out 5G networks, buying spectrum, but now we're in the phase where we're going to start harvesting that investment that is made over the last few years. As I mentioned, just in the last quarter, we've seen both Verizon and AT&T pull back on their capital spending. Cash flow is up. Prices are coming up. They're adding new products like fixed broadband. They're bundling in new ways. I think the long-term story is that the cash flow that pays the dividend is actually in a really good place. As a result, the 7.5%, 8% dividend right now is actually a really great buy for investors who just want to buy a stock and just collect that dividend quarter after quarter. So that's why these are the first 2 stocks on my list today. The second company is Gaming and Leisure Properties. This is a REIT. It owns a ton of casino assets in the US. So as a result, its clients, the people who are paying rent every month, are actually casinos. So you want to have a healthy business paying you, and that's exactly what they have in the casino business. This has been really surprising coming out of the pandemic, but actually the casino business has come back stronger than it was before the pandemic. Las Vegas is doing extremely well. Regional casinos are doing well. People are just wanting to go out and do things. And there are 3 metrics to look at, and they're all looking pretty solid for gaming and leisure properties. You can see that total debt of $6.5 billion means debt to EBITDA is 4.8x. That's reasonable for a REIT. Funds from operations nearly $1 billion, and look at that steady increase over time. They have been acquiring some properties, so that's one of the reasons that funds from operations are growing. Those funds from operations are ultimately where the dividend is coming from. The dividend yield as I'm recording is 6.1%, so not quite as high as Verizon or AT&T, but there are steady increases in the rents that casino companies are going to pay, and like I said, their businesses are doing well. So as long as these REITs can continue to refinance their debt or pay that down when necessary, these are ultimately going to be in a very good position long term to just continue paying that payout. The next 2 companies are again related. NextEra Energy Partners is a yieldco that owns a lot of solar and wind assets. Parent company is NextEra Energy. So this is basically their renewable energy arm. They buy renewable energy assets that have usually multi-decade contracts to sell electricity to utilities, fund those with debt and equity, and then any excess cash is paid out to investors in the form of a dividend. Hannon Armstrong is the other company, very similar model, buying a little bit different assets. Sometimes they're funding efficiency, sometimes they're buying land under a wind farm or a solar farm. So they're doing a little bit more unique financing activities, but they're very similar. They're both financing renewable energy projects, and efficiency projects. So kind of in the same realm in the energy field. And you can see here that both of them have dividend yields of over 6%. Those dividends have come up over the last year. Like I said, as interest rates have risen, as investors have demanded more payout from these stocks when they have alternatives that will pay them 5%. So the good news is that these are great dividends now. And like I said, specifically, and NextEra Energy in particular has contracts that often extend 20 years or more to sell electricity to utilities. So there's a lot of visibility to the cash flows. Hannon Armstrong is a little bit different. A lot of their projects are a little bit shorter, but they're able to finance based on the conditions in the market. So right now, interest rates are up. They're going to demand a little bit more payback from the projects that they're financing. So there's a little bit of a balance there. That's why these two companies are a little bit different. But in the energy space, the growth today is in things like efficiency, in wind, in solar, in energy storage. These are going to be two of the leaders in that market. And that's why I think investors who are interested in both renewable energy and in getting a dividend that has a lot of visibility into the future should look at NextEra Energy Partners and Hannon Armstrong, two of the leaders in the space. That's why they're among the top 5 dividend stocks that I have today. So let's go through those stocks again. AT&T, Gaming and Leisure Properties, which is a REIT. And then on the energy side, NextEra Energy Partners and Hannon Armstrong. All 5 of those dividends are in excess of 5%, really great payout, and they should be able to grow consistently over time as these companies grow their operations and earn more in cash flow. So what do you think about these 5 dividend stocks? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing, everybody. Thanks for watching.